I recently came across a CNBC article by Jessica Dickler entitled Consumer Credit Card Debt and Annual Percentage Rates Are Heading to an All-Time High. In the opening sentence of the article, she shares, to keep up with rising prices, consumers are leaning on their credit cards. Credit card balances rose year over year, reaching $841 billion in the first 3 months of 2022, according to data released from the Federal Reserve Bank of New York. Later on in the article, she shares this statement from Ted Rossman. There is a good chance that Americans' total credit card balances will soon reach a new record high, marking a sharp reversal from the precipitous drop that occurred in 2020 and early 2021. Later on in the article, she shares that credit card interest rates will become higher as the Federal Reserve continues to raise its interest rate to combat inflation, which we know is extremely high right now. And this is why I wanted to create this video. All credit cards have this one little word about its interest rate, and that is it is variable. In other words, as the Feds continue to raise the Federal Reserve rate, your credit card interest rates will follow suit and be raised as well. The credit card interest rates are raised so that the banks can remain profitable. In my previous video, and I'm going to link it up above, I shared the history about the credit card interest rate and how some banks were on the verge of bankruptcy due to a law that prevented them from raising interest rates above 12%. It's an excellent history lesson that I encourage you to watch, so be sure to check out that video. If you are thinking about getting a credit card, or if you have a credit card and don't understand how they work, then this is the video for you. In today's video, we are going to take it back to the basics and discuss how credit cards work and how APR is calculated. As you watch this video, if you find the information to be helpful, please be sure to hit the like button for the YouTube algorithm so that this video can reach more viewers like you. So how does the credit card work? The piece of plastic or metal, for those of you who have a fancy credit card, connects you to money that actually isn't yours. It connects to the bank's or credit card issuer's funds. Each credit card is connected to a revolving credit account at a financial institution, and every time the card is swiped to make a purchase, funds are effectively borrowed from the bank or financial institution to pay for products or services. The way that this works is instantaneous. You swipe your card, the bank pays the merchant or service provider, and then you are able to take your product home or receive the service you needed. This sounds exciting and amazing because you have access to spend someone else's money to buy almost whatever you want to buy. But there's a catch. There's always a catch. Catch number one. You will have a predetermined spending limit, which is known as your line of credit. Unless you have a charge card, then you won't have a credit limit, so to speak. Catch number two, you have to pay back all of the funds that you've borrowed. Sounds simple so far, right? But there are a few more catches to this thing, and we'll talk about the most important catch in the next segment of this video. Understanding how interest is charged to your credit card account is extremely important. The first thing you need to know is that you typically won't accrue any interest charges as long as you pay your credit card statement in full every month by the statement due date. This is known as the grace period. There are a few credit cards out there that charge you interest immediately, meaning they don't offer a grace period. So it'll be important to read the terms and conditions of your credit card agreement. If you ever find yourself in the unfortunate situation where you are unable to pay your statement in full, it'll be important for you to know how interest is calculated. For this example, we are going to go over a few scenarios. Let's say that you have a balance on your credit card of $1,000 and you've decided that you won't use your card again until you pay that balance in full. In this scenario, you'll have this balance for the entire statement period. To get a rough estimate of how much you'll be charged, you need to do a few things. First, find out your current APR, which is your annual percentage rate. This tends to change when the prime rate changes, so be sure to double check this. Secondly, let's say that your current APR is 23.99%. You take this 23.99% and divide that by 12. Why 12? There are 12 months in the year, so this will give you your monthly interest charge. The monthly interest charge here will be 1.999%. Thirdly, you take the $1,000 and multiply it by the 1.999% and get a total of $19.99 in interest for the month. I want you to remember that this is just a rough estimate. Now, what you really want to know is your daily interest charge. So we'll take the interest rate, which is 23.99%, and divide that by 365 days to get a daily interest charge of 0.066%. So on a $1,000 balance, you can expect to be charged 66 cents for 1 day's interest. So your balance will grow to $1,000.66. Let's apply this to an entire month. We'll take the $1,000, multiply it by 31 days, and multiply it again by 0.066%. We'll get a total of $20.46 in interest. So now you can begin to see why I mentioned that the first calculation was to give a rough estimate. This can get even more convoluted because interest is compounded daily and charged to your average daily balance. Depending on how much you use your credit card, this can become a daunting task to figure this out. To show the power of compound interest and how dangerous it can be to allow your credit card balance to grow to a number that you can't pay off, I'll increase the balance to $15,000 at the same interest rate. For day one, your interest charge will be $9.90. And that's just day one. If we were to take that charge and multiply it by 31 days, you'll end up with $306.90. And unfortunately, it'll be even more because the interest compounds daily. So for day number two, you'll be charged interest on $15,009.90. When we do the math for the next day, you'll see that your interest charge will increase by a penny to $9.91. Now your balance grows to $15,019.81. This continues to happen throughout this statement period. At the end of the 31 days, the total daily interest charge rises to $10.10, and the total amount charged in interest for the 31-day statement period is $309.96. This is the point where people can find themselves in a never-ending cycle of credit card debt. Typically, the minimum payment will be a small percentage of the statement balance plus all interest and fees. The percentage could be 1% of the balance, which in this case equates to $150. This can vary, so check your credit card agreement. It may also be located on your statement. Plus the $309.96 in interest. This gives a total payment due of $459.96. And keep in mind that the interest charges must be paid first before the balance for your purchases, and I'll call this the principal. That's really a monthly payment for a brand new car. So as you can see, credit card interest can grow pretty quickly and get out of hand if you aren't careful. The difference in interest on a balance of $1,000 and $15,000 is significant. As always, if you've made it to the end of this video, you've earned yourself a high five as a thank you for watching all the way to the end of this video. If you did learn something, be sure to hit that like button, subscribe to the channel, and hit that notification bell so you don't miss any future videos that I upload. So without further delay, you've earned a high five because you made it to the end of this video. So what are you waiting for? Come on, get your high five. I will see you in the next video. Take care, guys.